What's up, everybody? It's Jimmy Jackson here, Grand Rapids, Michigan, Realtor, Keller Williams, Grand Rapids North. And I'm going to make a video. Let me just jump on here really quick. I'm going to make a video on what is NOI. What is net operating income? So I'm just going to explain it really quick. And I'm going to actually put up a video so we can go over it. Net operating income is something that you're going to use when you are, figuring out your numbers, when you're doing your gross rental income and your other income, and you're adding in your operating expenses. So, like if you're doing commercial real estate, mainly, it's something that you want to show your potential investors, like your hard money lenders, your soft money lenders. You want to show them the net operating income so you can show them that their investment in you, if they're going to give you the money, or even a bank, is going to be worth it. So your gross rental income is the rent that you collect, that you bring in. Like in any other income is going to be like, parking fees. If you have like washer and dryers down there, if you charge for storage, also, what else could you, if you even had a vending machine, that would be any type of income that you bring in. So that'd be considered your gross rental income altogether. Now, your operating expenses, that would be like your property taxes, insurance, utilities. If the owner pays, if you would pay the utilities, your maintenance, your management fees, your repairs, and not your mortgage payments or capital expenditure. It's important to know these things because the investor also often uses your NOI with your cap rate to estimate your property value. So it shows the property's operations that generates enough income to cover the expenses over time, to see that it's worth it. Is the income you're bringing in going to cover the amount of money it's going to cost you? Are you bringing enough money in from all those incomes that I talked about to cover how much you're going to be paying for things? And these are things that lending, like banks, like I said, hard money, blah, 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 that they review to determine if the property is worth it. So let's check out the video and let's let a professional explain it a little better than I can. We'll show you an example. I'll explain it better than me. Let's listen in.
We're going to talk about net operating income, or NOI. NOI is the driving number behind the valuation of commercial real estate. And it's important to understand where that number comes from, how it's used, and the significance that it has over our investments. Net operating income is exactly that. It's the net income from operations after all of the operating expenses have been paid. So if this is our total revenue and then we have our expenses, this is our NOI. Now, NOI can be used for a lot of things. For instance, if we take our NOI and we divide it by our purchase price or value, that gives us our cap rate. NOI can also be used to calculate, if we take our annual debt service, or NOI divided by our annual debt service, that gives us our debt service coverage ratio. And finally, since NOI is what we use to pay our debt service, if we take the NOI minus the debt service, that gives us our net cash flow, which we can use to calculate our cash on cash return.
So, like you just said, your NOI minus your debt service is going to be your cash flow. So you want to make sure that you pay attention to that. That's going to be your cash flow. Your cap rate is pretty, these are pretty self-explanatory, but I just wanted to stop to, let's just soak all this information in really quick. So go online, find a commercial property. You can, you can even find a residential property and practice it with this as well. Um, as long as you have an NOI, cap rate, a debt service coverage, and a net cash flow, you can figure this stuff out.
Here are the steps to calculating the NOI on a property. First, we need to know what our scheduled rents are. Scheduled rents are the rents that would be collected on the property if all spaces or units were completely full 100% of the year. Effectively, it's the rent roll or the lease schedule times 12 months for the total annual rents. From there, most of the time, we have an assumed vacancy. Vacancy can be variable depending on the market. However, most of the time, we must always assume that some vacancy is going to happen, and the industry standard for at least multifamily vacancy or most investment properties is 5%. From there, we also get other income. Other income can be laundry income, application fees, or credit check fees, late fees, non-sufficient funds, anything that isn't part of the rent roll but is still income to the property. And if we add these, obviously this is a negative, so we would subtract that and add that, we get our effective gross income. Effective gross income, or EGI, is basically our net revenue number. From there, we need to take out operating expenses. Important note is that operating expenses do not include debt service or payments to the owner, but they are expenses that are related strictly to the operation of the property. So, for example, operating expenses would include things like real estate taxes, hazard insurance, property management, utilities, repairs and maintenance.
So I'm just pausing the video again to show you, like, this is how you do the math. Like, I can run my mouth and tell you blah, 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 but he's showing you firsthand how you do it. So get a piece of paper, get a pen, and practice, 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 practice. This is how you do it. This is how you figure it out. Use AI. You know what I'm saying? Use ChatGPT and pretend that you are buying go online, look for commercial real estate. Look for commercial real estate that costs 1.7 million and it's 20 units, and add up the numbers and see it. Just pretend.
Anything that is necessary to operate the property, along with collecting the rents, considered operating expenses. Those would be our total expenses. And then if we take our effective gross income minus our total operating expenses, we get our NOI.
There you go. There you go. Now you can go buy an apartment complex, a 4-unit. These are the numbers to figure these things out. It's doable. So I just want to say thank you for tuning in. Appreciate it. Like and follow. I don't know why that just went in that spot, but that didn't look very good. Lesson learned. And have an amazing, blessed day. Thank you very much. Bye.